Welcome back. This is your official economic review this morning. My name is Simba Elijah Charles Kianga. Let me introduce our guests today. In the morning, we are joined this morning by Josh Onsando, who's a public policy analyst and political strategist. We're also waiting for Gabriel Mwendo, who's an investment associate, Horizon Africa Capital. Let's introduce that first story for you this morning, where Equity Group shareholders have adopted a policy that will guarantee a dividend payout of between 30% and 50% of its profit after tax beginning from the current financial year ending 31st December 2021. The formulation of the policy comes against the backdrop of its decision to withhold a dividend payment last year following the COVID-19 fallout. Speaking during the group's annual general meeting, Equity Group Managing Director and CEO Dr. James Mwangi said the board's move last year was to preserve capital amidst the prevailing uncertainty, and the board is confident that the measures taken have borne fruit. In addition, due to the pandemic, the group accommodated 171 billion shillings of loans for customers whose repayment capacity was adversely affected by the pandemic. As of 31st December, 40 billion of the restructured loans had resumed repayments and normalized. However, 9 billion shillings have been downgraded to non-performing loans over doubts on the future viability of the quality of loans. Let's cross over and see exactly how equity performed in the financial year 2020, that is ending 31st of December 2020. Let's look at exactly where they were in terms of their total assets. We do know that because of that non-dividend payout season, that it crossed the 1 trillion shillings mark, and total liabilities stood at that point and now was contributed heavily to those loans that they had restructured. And we're also talking about the shareholder funds, which also went high to that mark as well. Let's cross over to what was their total interest income, which we do not crossed the 70 billion mark as well. Profit before tax was at 22 billion, and now profit after tax was at 20 billion shillings. And that they did not pay their dividend payout. Good. Let's talk about that now this morning. Josh, and I would start with this question. They've announced that, well, at the end of this year, they're going to pay their dividend, and they've attached a 30 to 50% mark of their annual net profit dividends. The current one, the one that ran up to the year ending at 2020, it was not fixed. Is that an indication that equity is saying now things are back to normal in the economy?
Well, when Equity first announced that they were freezing dividend payouts, it was a part of a raft of measures that were created, were designed to create a buffer, to ride out the COVID wave. And so I think what it is an indicator of is the fact that that buffer, with all the measures, including the freeze of the dividend payout, has been sufficient enough to help them ride this wave.
Yes.
Whether or not that is an indicator that they're saying things are back to normal, I don't think so.
Yes.
I think when you're talking of about 20% of restructured loans being classified down to non-performing loans, that is a scary prospect. And I think depending on how fast the economy recovers, I think we're still a while away from saying that things are back to normal.
Yes.
But what it is an indicator of is that the measures they took to create that buffer that they had spoken of at the beginning of the pandemic, those measures have been sufficient enough to help them ride this turbulence.
Pretty much, it's a good thing that you're saying those measures they took were sufficient enough for them to ride this turbulence. Let's look at them as well, because we do know that earnings jumped by 50 billion during that period, or by 64% to 127.4 billion. That is in terms of their revenue. When you look at it, Josh, and then during that period, actually they did not pay dividends for 2 running years. equity just didn't start now. They started just a year before last year. So when you look at that now, Josh, and compared with what is going on in the economy, would you say that they are optimistic? Because somebody would say, well, they have money now, they can pay dividends for the end of this year. But is that being optimistic enough that things are going to get better?
I think it's a signal. I think they're signaling that that things are getting better, and I think also you have to consider that for institutions such as equity and the banking industry, it is important that they send out that signal because you need confidence in the economy for the banks to survive. Because the banks are remember a couple of shows ago we were talking about how we have frontline workers who are the healthcare workers. For the economy, the bank is a frontline worker, and so. I think they are sending out a strong signal, and I think it is important that not just equity, but banks across the board send out that signal. Now, with regards to whether the banking sector has recovered from COVID-19, I would like to look at it a bit differently, because for me, how I look at it is COVID was a diagnostician, so to speak, of the problems of the banking industry, particularly in Africa. And I think McKinsey, probably a year ago, did out a report on that, and what it points out to is, for me, the banking sector recovering is to what extent has COVID pushed the banks to carry out fundamental reforms within their business models. So, for example, you find that in Africa, and we're talking continent-wide, the cost to asset ratio of banks is one of the highest in the world.
Yes.
It's not the highest. So are banks working to create fundamental changes to reduce that cost to asset ratio? In other words, what is the cost of serving a customer? And so even as you look at the earnings that are jumping for equity and for other banks, again, a fundamental question would be to ask what percentage of that income is non-funded and what percentage of that income is funded income. Because if you have a large percentage of non-funded income in an environment where there are so many options, where every other day there are new financial products coming to the market, then it's a bit tricky. Because I'll give you an example. I think if you talk to any equity bank account holder, they'll tell you that they got a message recently where they are supposed to pay 240 shillings a year for, I think it's an ATM subscriptions of sort.
Yes.
Now, if you look at a bank with 10 million subscribers, 240 shillings a year is 2.4 billion shillings. So we would expect that at the end of this financial year or the next financial year, that we'll have a bump of 2.4 billion shillings in equity earnings. But is that really sustainable? In an environment where you have all these other ATM products available and substitutes available. So I think for me, I would say that yes, there's confidence and banks are signaling that we are on the path to recovery, and that's a good thing. But for me, if you asked me what COVID recovery for the banking sector in Africa would mean,
yes,
I think it would mean that a total relook at how business is done, a total change of business model, innovation, increasing the turnaround time for loans, for example. So I think it's more fundamental than just because COVID just came to show us that this thing is fragile. So you need the institutional framework and institutional framework reforms, business model reforms within the banking sector.
Right, let's look at what this meeting really bore. I mean, Josh, now they said that anybody who's a shareholder at equity now with a 12.5% stake will have a right to a board seat. Now, let's put it in mind that nobody currently at equity has that stake. The biggest shareholder is Arise BV at 11.99% stake. So not there yet. For you, what do you read into this? Because they're also saying that, well, any other shareholder who has a 12.5% stake has a right to also choose a director, but they've capped the nominations of those directors to just 4. Currently, again, the directors of equity, none of them are bigger shareholders. I mean, James Mwangi has just a 3% stake at equity. What do you read into this, Josh?
I think I read this might be a purveyor of some sort of boardroom moves that are going to be done at equity.
Yes.
And I think they're laying the ground to, perhaps, at this point in time, we have a bank that has grown leaps and bounds. So, there's definitely going to be behind the scene power struggles in the boardroom. So, I don't want to sound too skeptical, but I think that perhaps this is a purveyor for maybe some people who are making a move towards trying to have an influence on board appointments.
Yes.
And so you set a target that no one can reach. So then, the status quo remains. So it could be one of a million things, but I think that it's definitely an indicator that there is a push and pull in the background that we might not be privy to.
Yes.
As commentators on the outside, yes.
Yes. And I don't know whether we do have Gabriel in the studio this morning. Gabriel, good morning, sir.
Good morning to you, Simba. How are you doing?
We're doing okay, man. Thank you very much for joining us. Let me just throw you into the deep right away, Gabriel, this morning. Now, if you look at exactly what equity is doing, now, Josh has just responded to that question. They're saying that anybody who has a 12.5% stake will have a right to a board seat at the company. Good. That is one. And they're saying that anybody, again, with a 12.5 stake at equity will have a right to nominate one director. But then they're looking at it and saying that should more than 4 of you have more than a 12.5% stake, we are going to cap that nomination at just 4 directors that are coming from any shareholder that might have a 12.5% stake at equity. Well, Gabriel, at equity, nobody has a 12% stake. The biggest one is by Arise BV at 11.99%. James Wong himself has just a 3% stake. In fact, none of the current directors have that much of a stake at equity. What do you read into this, Gabriel?
I think it's just proper corporate governance and planning because, for example, we've seen quite a bit of investor activism with some other companies that listed on the exchange, whereby people who have, 11.9 want to go higher to the 12, 13. The likes of Centum, we saw the late Kirubi want to buy more. We've seen the same with Kakuzi. So it might also be an incentive for the gentleman with 11.9. Do you want to grab more? Here's the incentive for you. And then again, remember they're doing quite a bit of acquisitions.
Yes.
So I do feel that there might come a time whereby, assuming you buy a bank that is owned 70% by one group, so if you are to give them shares in equity group, then they might easily cross the 12.5, depending on the balance sheet of the company that you just merged with.
Yes.
And if you're giving them shares, they might cross that. So it's just proper corporate governance because it's something you ought to do as people get closer to that range of shareholding where they actually want to be represented on the board.
Pretty much. Gabriel, just before we cross over to the next one, because it's pretty much interlinked to what we're talking about now, they did also announce that they have a fixed figure that they work with now as from at the end of this financial year, that is ending at 31st December 2021. They're going to start paying dividends, but now for the very first time they're saying they'll cap it at 30 to 50% of their revenue. Before that, we've not had it on a fixed figure. What do you read into that as well, Gabriel, going to the fact that they've not been able to pay the dividends for the past 2 years?
So one, in terms of being able to pay dividends, the banking sector is enjoying a lot of liquidity. There's a lot of liquidity in the banking sector.
Yes.
And especially with Equity Bank. They've grown their asset base significantly without growing their loan base and their loan asset at the same rate, which tells you they have a lot of cash lying in T-bills or in cash.
Yes.
So since they have shown us they don't have much to do with that money, it was just right for them to give it to the investors. That's what I read to it. It was long overdue. They should have not stopped to pay that dividend. They have a lot of cash. So if they can't deploy it, just give it to investors as they have done. Now, to your second question of capping it at 30 to 50%,
yes,
I think it's just for planning. Unfortunately, it limits, that limit of say 50. it sort of anyway prepares investors in a way. So if you see their half year, you can start estimating how much you can actually expect in dividends. I think all these changes might be coming in from, I think probably they went through some corporate governance reorganization or something that they just needed to set something straight. And I think some push may have come from some of the significant shareholders, whether it's even 2%, saying we can't go without a dividend. So we need to have a dividend policy actually in place.
Yes.
So that these decisions actually we can be able to plan ahead of it, because we have so many funds, pension funds, local and international, who are actually relying on those dividends. So I think that policy at least allows investors to plan, and Equity Bank has a lot of cash they will be able to pay without a problem.
Is there an indication, Gabriel, that we are headed in the right direction in terms of the economy recovery now, since Equity is now saying, well, we're going to give you a dividend at the end of this year?
No. In fact, might be the opposite. It means that Equity Bank does not have profitable customers to lend to.
Yes.
If there was business on the table, you do that business. If there was people to give loans to, you give. That's the business.
Yes.
It means their business is not lucrative enough. They actually ran back to give money to investors. Given how, like I said, the book is not moving.
Would they fight you? Would they fight you if you say that? Because we do know they were rated among the most profitable bank in 2020.
Profitability is fine, and I have no doubt Mr. Mwangi can make money. That's not a problem.
Yes.
But your question was, what does that mean to the economy?
Yes.
It means there are not enough businesses to lend to, because if there was, then would be very much higher loan to deposit ratios. They would not be having as much liquidity as they do. Equity Bank is a bank to go to for so many people, including myself. It's the bank to go to for very many people, and you can see their customer numbers. So it means they do get now loan applications. So it does mean they might have turned down quite a bit of loan applications, which tells you that the economy is not where they might want it, so that they can continue lending to the higher loan to deposit ratios that we've seen them hit in the past.
Yes.
So it tells you that they're still preferring government and preferring to hold cash for the time being.
Pretty much. Gentlemen, let's cross over quickly to the next issue this morning, where the Kenya Bankers Association, KBA, last week elected NCBA Bank Managing Director and CEO John Gashora and Family Bank Chief Executive Officer Rebecca Mbidi as the incoming chairperson and vice chairperson, respectively, for the period 2021-2022. New chairperson previously served as vice chairperson takes over from Mr. Joshua Oigara, who chaired the KBA Governing Council for the past 3 years. KBA Chief Executive Officer Dr. Habila Laka thanked Mr. Oigara for his service over the years, while welcoming to the umbrella Capitas Microfinance Bank, which joined the association in 2020. He expressed his confidence that the bank will contribute to the long-term vision of reinforcing the industry's role in advancing Kenya's sustainable economic development. Good. Before we cross over to Josh this morning, let's look at exactly where we are in terms of the performance of the banking industry. That is key performance indicators as of January 2021. Those are the unaudited ones that we do know. We see exactly where the gross loans are. We're going to give you that trend again for the gross loans, because that's where the talking point is this morning. Let's cross over to another area as well. That's where we are. That is in quarter 1 of 2021. Still unaudited, and you can see exactly how banks are performing under profit before tax. We've had majority of them, yes, record profit gains in 2021, sort of saying that things are getting back to normal, if you may want to say that this morning. Now let's cross over and see that trend for gross loans again in the economy now. Richie, if you could jump and give me that data for gross loans, if you have it. Do you? Yes, as we wait for it, Richie. You do have it, by the way. Anyway, Josh, let me ask that question, if we may, this morning. And I want to ask it from this perspective. Let's look at exactly what has been the performance of a Family Bank. Again, Richie, if you could jump into that data, because they've been quite outstanding in terms of their performance. In fact, they were the only bank that has not been affected by the coronavirus pandemic. You can actually say that again, they've been recording profits for the entire of 2020. Quarter one of 2021, again, they were the outstanding performance as well. Let's cross over to another area of their performance as well. That's where they are in terms of their profit trend. You can see 2019 jumped, 2020 jumped as well. All right, let's cross over to NCBA and look at their performance as well, because they have a representative now. In terms of their profit before tax and after tax, they were ones who were really affected by the coronavirus pandemic. Let's cross over to another area in terms of their profit trend. Can we look at that, Richie? Yes, we do have it in 2019, but you can actually see they recovered in a 2020 as well, albeit by a smaller margin. That's fine. If we're going to use that as a criteria for them really taking over as chair and vice chair, then you could say they do qualify because they were performing in a 2020. But before, Josh, I ask you that question, what would you credit the outgoing team, and specifically this man, Joshua Igara, what would you say was his bigger impact in that seat as chair of KBA?
I think Joshua Igara was at the helm of the KBA at a very tricky time, because it was, I mean, he came in smack in the middle smack in the beginning of the pandemic, and so he had been in office for about a year, and then the pandemic hit.
Yes.
And you had this push and pull between the regulator and the banks on what role the banks should play in steadying the ship in terms of the economy through the pandemic. And so I think yes, I mean, he played a pretty critical role in that regard. But when I look at KBA is a lobby group,
yes,
so to speak. So from a policy analyst perspective, I mean, this is the face of the banking industry in interacting with the regulator. And I think because of the roles that banks are playing, and because of particularly this regime's overdependence on borrowing, and particularly domestic borrowing, KBA has quite considerable leverage. So I don't think it really matters who's at the helm at what particular time, except that you need to maintain a certain level of institutional memory within the lobby group. And that's why I think you're seeing the vice chairman transitioning into the chairman. And I think you'll see that after 2 years that the NCBA CEO will then transition into the chairman. But I think they have a very strong secretariat. They have a very capable managing director. So when I look at KBA as an institution, I think it's a lobby institution that has a lot of leverage compared to, say, for example, the Kenya Association of Manufacturers or the private sector alliance, KEPSA. KBA is perhaps the crown jewel of lobby groups in Kenya, particularly because of the leverage they hold against government.
Yes.
So I wouldn't read it much into. I mean, I see a lot of stability going forward in terms of how the institution is run, and I see that power that they have and that leverage maintain over the next foreseeable future.
Pretty much. Gabriel, let me ask you that question as well. I mean, the new team is coming in, yes. We do know that they have a representative from NCBA and Family Bank. And Family Bank specifically has been doing good business with the government. What do you see in that appointment or in that election of the two new faces at KBA? And generally, Gabriel, what would you credit the association's impact in the industry to be at a time when they were fighting the cap rate and also the coronavirus pandemic regulations?
Yeah, I think just to agree with one point Josh has made is that, the Kenya Bankers Association does have a very strong secretariat.
Yes.
So they don't really, it's almost the position of chair and vice chair is very close to ceremonial. Yes, you do have some insights and, you do bring in your own input, but it's really driven by, what the members and what the other bankers are sort of speaking. You have to speak on behalf of the other, of the members.
Yes.
So it's more of a discussion, you're more of a point person.
Yes.
But of course, as far as their profile goes, they do fit the profile. I don't think it's an easy fit to become CEO of either NCBA or Family Bank. They're both professionals and very overqualified
Yes.
for those positions. So they both have very good track records. That's fine. But as far as in terms of this association, the KBA performance, in the two scenarios you've mentioned, I mean, obviously they were not for the red cap. They were ignored. So was the CBK. But what augurs well for them is that at least they were in sync with the regulator,
Yes.
which is the Central Bank of Kenya, and that really is what is most important for them. It's really to be in sync with the regulator, so that some of these decisions do not cause any conflict with any of the specific members. Because I'm happy we've never seen a scenario whereby sort of half of the banks are sort of going this direction and half of the banks want to go this direction, and the regulator is in agreement with this half while fighting the other half. It's been a very level playing field. This association serves us all, despite our competition across other platforms. Now, the KBA, I think, should be credited very much for the products they've come up with. I mean, we have the likes of PesaLink. They have actually driven some level of innovation within the banking sector.
Yes.
And people might not see it, but among the banked population, it does compete quite well with the products from other competition outside other sectors like Safaricom, because Safaricom is a competitor outside. What it will be interesting for me is to see whether Safaricom gets better relations with the banking sector, given its relationship with NCBA, because I mean now they are working in sync, banking sector and telcos. But let's see if that improves, given the history Safaricom has with NCBA. But in terms of lobbying, I think they have done their best in the face of COVID. Like I've said, they have a lot of liquidity. They just now need to remember to go back to lending quite a bit.
Pretty much. Gentlemen, I'd like us to take a break because Gabriel and Josh, I'll come back and note on that shortly. There was that small rumble. And Gabriel, I'll ask you though, you mentioned something very important as well, that, this lobby group seem to be in sync majority of the times with the regulator, and we do know that is the CBK. Does that normally go well with what a lobby group should be doing? Because we do know there has been some rumblings on just how the CBK is not allowing the banks in the country to price their products properly, even after the removal of the red cap. Should they do something about it? Because that is where the conversation point comes once we come here from the break on a Business AM. Get us online at Metropole TVKE across all your social media platforms.